Meanwhile, share markets nosedived in Asia on Monday amid surging oil prices due to ongoing tensions in West Asia after US and Israel waged war against Iran. The Indian stock market experienced a significant crash in early Monday, with the Sensex falling over 2,300 points and Nifty Bank dropping below 2,400, erasing over rupees 15 lakh crore in investor wealth. The crash was driven by escalating geopolitical tensions, a sharp surge in crude oil prices, and intense foreign institutional investor selling. Over $130 billion was wiped off the Australian Securities Exchange alone in the first 2 hours of the trading in the morning. Brent soared 23% to $117 a barrel, the biggest daily gain since at least 1988. A 28% rise last week. U.S. crude shot up to staggering 27% to $115.11, threatening to push petrol prices quickly skyward. Well, Karthik, as we see the numbers, the oil prices are skyrocketing and the markets are now bleeding. Sensex has crashed, Nifty has crashed. What more do we expect? What it means? How does it directly impact the Indian equities at this point?
So see, equities is one side of the story, the economy is the second part of the story, and the third is, of course, the impact on consumers. Now, is there going to be a sticker shock for fuel pumps as you go and top up your cars with petrol or diesel? That is the big question which is looming over Indian consumers at the moment, and that is something which is playing out on the stock market as well. If you see stocks of Maruti Suzuki and other automakers, they're all down between 3% to 5% or so in early trade today. So the question really is there going to be a sticker shock awaiting Indian consumers as they line up at petrol pumps? Well, the simple answer to that is not immediately, because remember, when oil had fallen from about $85 a barrel to below $60 a barrel, the government did not reduce fuel prices, and in fact the oil marketing companies continued to profit, which meant that the government added something called the windfall tax on oil marketing companies. The government taxed them for the supernormal profits they were making on account of reduced crude oil prices and not passing on those reduced prices to consumers. Now the government is first going to withdraw that windfall tax and also use perhaps some of those proceeds to pump back into keeping the domestic oil prices stable. So the good news, seemingly at least right now, is that with India's existing stockpile of about a month of supplies, plus the 30-day window for India to import Russian oil, should ensure that at least immediately there is not going to be any sticker shock for petrol or diesel prices. So that is number one. But there is a second aspect to that. The second aspect is inflation, because remember, with every increase in crude oil prices, the price of oil which comes into India increases, and that is something which is likely to over time add to India's inflation woes and also add to India's current account deficit to widen, and that is likely to have a larger impact on the Indian economy. So, these are two aspects of globally when oil prices rise, how they end up impacting consumers and end up impacting, the economy at large. But coming specifically to stock markets, well, you are seeing today, beyond the Sensex story and beyond the Nifty 50 story, the oil marketing companies, their stocks have tanked about 7% or so in early trade. So I'm talking about IOCL, BPCL, HPCL, all these three oil marketing companies which are supplying the fuel to end consumers. Their stocks have fallen about 7%. In fact, in some cases more than 7%, about 7.5% or so, simply because their input cost is going to be higher, but the output cost, as long as government ensures that oil prices are kept steady, is going to shrink, cushion, in fact squeeze their profitability and their profit margins. So this is largely likely to impact investors who are invested in the oil marketing story. But we are not seeing as much impact on Reliance Industries, which is among the largest refiners. And this could also be because of the diversified business conglomerate that Reliance already is. So Reliance is holding on firm. In fact, the stock has been volatile. It has seen some downs, but also some ups in the first few hours of trading this morning. Now, we don't know how that story is going to pan out from here. But overall, as far as equity investors are concerned, well, volatility in the Indian market is absolutely high. It has reached levels of about 24 when the average is around 12. So the India volatility index, or the India VIX, is also referred to as the fear index. It's a gauge of how much fear there is amid investors, and that fear seems to be almost at an all-time high of about 24. So that, of course, ensures that there is going to be volatility. There could be some traders who benefit from this, but investors, long-term investors, are in for at least some prolonged agony as far as equity returns are concerned.
Well, that's right, Karthik. US President Donald Trump has said that this is just a small price that everyone should pay for world peace, and he has also assured that the prices will go down once their strategic objective is achieved in their war against Iran. But how severe this will, I think this is not going to be a small price for countries like India, which are like highly dependent on on crude imports.
Right. I think we should look at President Donald Trump's statement in light of the small price, according to him, the small price that U.S. consumers will pay. Because remember, the U.S. Oil marketing companies and the petrol pump prices or the fuel pump prices in the U.S. are directly linked to global crude oil supply. So every time there's a cut, that cut is passed on. Every time there's a hike, that hike is passed on. So overall, the shock or the impact on U.S. consumers and the U.S. economy as well as the U.S. markets is expected to be much harder than for India, because in India you still have some sort of a cushion which has been created over time, and that cushion is going to protect, at least for some time, the Indian consumers from that sticker shock. So I think the small price to pay that the US president is talking about, small or big, one doesn't really know, but that is something which is more for the US consumers, not as much for Indian consumers at the moment. But again, the Indian consumers are paying in other ways, and those ways could be, of course, added inflation over the year, and of course, reduced growth rate for the Indian economy. These could be some ways in which the Indian consumer could pay. But remember, India is still largely, protected from the kind of spikes that we've seen, or the kind of severe falls that we've seen in its Asian peers. So look at the Japanese stock market. The Nikkei 225 benchmark index of Japan is down about 7% or so in trade this morning. So is the case with South Korea's Kospi. So these economies are taking a much ruder shock to what we are seeing in global oil prices as compared to India, at least in the immediate aftermath of the spiking, oil prices. But then there's also the statement which came early morning from Goldman Sachs, which is expecting that crude oil could touch about $150 a barrel. So right now at about 117, which has gone up to 119. India is in the vicinity of about $120 a barrel right now. But if this goes up to about $150 a barrel, then of course, the price of oil overall globally increases. So whether India imports from West Asia, whether India imports from Russia, or over time India starts importing from the US, the benchmark crude oil price at $150 or even at $120, if it were to sustain at those levels, is going to be a big price to pay for consumers across the world, not just in the US.